So let's talk about something that's on pretty much everyone's mind: high inflation, economic uncertainty. It can really feel like your hard-earned wealth is just under constant attack, right? Well, today, we're going to demystify how to not just protect your money, but actually grow it by learning from some of the absolute masters of value and risk.
All right, so here's our roadmap. First up, we're going to identify the sneaky enemy that's silently eating away at your savings. Then, we'll draw a really clear line between true investing and what's just risky speculation. After that, we'll dive right into Warren Buffett's playbook for thriving in times like these, learn about the ultimate defensive strategy, and finally, we're going to confront the one person who can derail this whole plan, and that's you.
Okay, so first things first, we have to really understand what we're up against. You see, inflation isn't just some number you hear on the news. It's this persistent, quiet force that is constantly eroding the value of every single dollar you save. It's a silent thief.
You really have to think of this as a battle plan. Your opponent, inflation, is working against you 24/7, trying to make your savings worth less and less. So to win, you need a real strategy, not just wishful thinking.
You know, the actual mechanics of it are pretty straightforward. When more money gets created and pumped into the system, the money that's already out there just buys less stuff. It's a fundamental rule of economics, and it has a direct impact on your real-world purchasing power.
And this is where it gets really real. Even with a so-called healthy 2% inflation target, just holding cash is a guaranteed losing game. Every single year, your money buys a little bit less. So the only way to actually win this fight is to make your money grow faster than inflation is devaluing it.
So, when people start feeling that inflationary pressure, what happens? Well, it's super tempting to go chasing after some kind of quick fix. But we have to understand the huge fundamental difference between real investing and the dangerous mirage of speculation.
So let's start with the gold standard definition, right from Benjamin Graham, who's basically the father of value investing. A true investment is treated like a business decision. You do your homework, your thorough analysis, you aim to keep your initial capital safe, and you expect a reasonable return. Anything that doesn't tick those boxes, well, it's something else.
Now, speculation, that's a whole different animal. It's all about betting on which way the price is going to move. You buy something not because of the value it creates, but simply because you're hoping some other person, a greater fool maybe, will come along and pay you more for it later on. It's a game of psychology, not of business fundamentals.
In this slide, it lays it out perfectly. An investor buys a piece of a productive business, something that actually makes money, that generates cash. A speculator, on the other hand, buys a non-productive object, whether it's a lump of gold, a piece of art, a crypto token, and just hopes and prays that the price goes up.
This is such a simple but powerful way to think about the problem with these non-productive assets. A kilo of gold is not going to have little baby kilos of gold. It doesn't create anything, it just sits there. Its value is 100% dependent on what somebody else is willing to pay for it in the future.
Which brings us to this question, inspired by that famous scene from The Princess Bride. Trying to guess what the market's going to do next based only on the price? Well, it's like trying to guess which goblet has the poison. You have absolutely no idea what information, what expectations, or what madness is already baked into that price.
Okay, so if chasing prices and speculating isn't the answer, then what is? Well, the solution lies in owning pieces of actual businesses that can not just survive, but actually thrive during inflationary times. And for that, we turn to Warren Buffett's time-tested playbook. What Buffett's looking for are basically financial fortresses. These are businesses that don't need to constantly pour tons of money back in just to keep the lights on. They have a brand that is so strong they can actually raise their prices and people will still buy their product. Think about Coca-Cola. They've been selling pretty much the same sugary brown water for a century, which keeps their costs incredibly low.
And the flip side of that coin is just as important. The absolute worst kind of business to own when inflation is high is one that has to spend enormous amounts of cash on new factories or equipment just to stay competitive. Why? Because all their profits get absolutely crushed by the rising cost of simply maintaining their operations.
Okay, this brings us to what might be the single most important concept in all of value investing. This is your ultimate protection. It's your buffer against uncertainty, against your own mistakes, against just plain bad luck. It is called the margin of safety.
Graham himself said this was the secret sauce, the central idea of the whole thing. It's not about fighting the next hot stock tip. It's about building in a cushion that protects your original investment no matter what.
So how does it actually work in practice?
Well, it's really a simple three-step process. Step 1, you do the homework. You figure out what a business is really worth, its intrinsic value, based on its ability to generate cash over time. Step 2, you look at the stock price, what the market is selling it for. And step 3, the crucial part, you only buy when there is a significant discount between the price and the value.
All right, let's put some numbers to this to make it super clear. Let's say an expert, maybe it's you, values a stock at $220 a share. And you look at the market, and it's currently trading for $210.
So the question is, based on everything we've just learned about needing a margin of safety, what do you do? Is this a good investment? Is it time to buy?
And if you're following Graham's logic, the answer is a hard no. Absolutely not. A 5% discount isn't a margin of safety, it's a rounding error. What happens if your valuation was just a little too optimistic? Or what if the company has one bad quarter? Boom! Your tiny buffer is gone. You need a big discount to protect you from all the things you can't predict.
But here's the thing. Even if you find the perfect company and you buy it with a huge margin of safety, you still have to operate in the wild world of the stock market. And the market is driven by powerful, cyclical, and often totally irrational emotions.
In this slide, it just perfectly captures that emotional pendulum. It swings all the way from optimism to outright greed, which pushes prices way too high. And then it swings all the way back to pessimism and pure fear, which drags prices way too low. And guess what? This cycle repeats over and over. The key for a smart investor is to use these swings to their advantage, not to become a victim of them.
And this is where you really need to redefine what winning looks like. Success in this game isn't about never losing money. It's about protecting your capital. If the whole market is down 35% and you're only down 10, that's not a loss. That's a huge victory. It means you're positioned for incredible gains when things eventually turn around.
All right, we've covered a lot. But this last part, this is the final boss battle. And honestly, it's the toughest one. Because after all the analysis and all the strategy, the biggest obstacle standing in your way is staring right back at you in the mirror.
Because at the end of the day, you can have all the spreadsheets and financial models in the world, but they won't save you from, well, from yourself. It's those deep-seated human impulses, the greed you feel when everyone's making money, and the terror you feel when the market is crashing that cause people to do the exact wrong thing. Buy high and sell low.
I think this Buffett quote just nails it. Wise investors take action in the beginning when it's logical and based on value, even if it feels scary or unpopular. Fools wait until the very end, until it's emotionally easy, and then they follow the crowd right off the cliff.
So there you have it. You have the playbook. Understand the enemy, which is inflation. Choose to invest, don't speculate. Find those resilient fortress-like businesses. Always, always demand a margin of safety and master your own emotions. The framework is yours. The only question left is, what are you going to do with it?